Okay, welcome everyone. Welcome to this EDEC-Infra webinar on strategic asset allocation with unlisted infrastructure equity and debt. Now, this is clearly a popular topic. There's more than 400 people registered for this webinar, and we've also received some preliminary questions, which is interesting, from some of you in Canada and New York, so maybe those who are still asleep right now, people from Australia, from Europe, etc. And it's true that as infrastructure becomes an asset class to which more and more investors want to have access, we see that these questions of where it sits in a portfolio and how it relates to other asset classes have become essential ones. For instance, pension funds in Switzerland have recently started to recognize its infrastructure as a fully fledged asset class. But so how much infrastructure should they invest in, and expecting what impact on the portfolio? So today we'll provide some of the answers to these questions and also highlight the directions for some future research on this topic, especially the integration of the liabilities in our understanding of the role of infrastructure investment in the portfolio. So let's get started. We will be your host today. I'm Frederic Blanbreux, the director and founder of EDEC-Infra, and I'm joined by my colleague Abhishek Gupta, who is heavily involved in the design and the application of our index data and produced the research results that you will see today. Abhishek, are you there?
Yes, Frederic, thank you. And hello, everyone. Welcome to this webinar today.
The usual few words of housekeeping. We will try and keep this down to 40 minutes and leave some space for some questions, and also have a couple of poll questions, as we always do. We will take all your questions in writing, so please use the Q&A menu on your screen to ask questions, and we will look at them at the end. We'll try to answer all of your questions, but if not, we'll try and follow up afterwards by email. And also this webinar is recorded. Very briefly, for those who don't know us, but in the interest of time, I'll keep this short. EDEC-Infra was originally an academic project at EDEC Business School, funded by public and private sector grants. And today we're a commercial provider of indices for unlisted infrastructure investors. So we produce more than 400 indices and sub-indices every quarter. We just put out our Q3 2020 results. And our indices are used by major investors in the sector, from North America to Europe to Australia, for investment research, to monitor different mandates, but also to better understand the risks of infrastructure in the portfolio. And that will very much be our topic today. Right. So just a few words on strategic asset allocation. It's the most important set of decisions that investors make about their portfolio. That's well known and well researched. Strategic asset allocations determines the majority of investment outcomes. So when it comes to infrastructure, in fact, there is nothing but the strategic level. Right? We're talking about highly liquid, long-term, long-only positions. There's no such thing as tactical asset allocation to infrastructure. So whatever decisions are made in this respect will determine the eventual impact and value added of infrastructure in the portfolio. You could say that this is the first order problem that all investors considering infrastructure as an asset class have to answer. Now, what we know is that investors so far have not been addressing this question very well. In the 2019 survey, EDEC-Infra survey on benchmarking, we showed that most investors still use absolute return benchmarks, which are, of course, pretty useless for asset allocation because they are absolute return benchmarks. And this lack of data leads to very low allocation. So if you look at the latest OECD survey of large pension plans and how they allocate to infrastructure, we see that only looking at the large asset owners, they invest low levels of their assets in infrastructure, around 2% on average, and many of the smaller asset owners don't invest in infrastructure at all. Now, this is normal. If you cannot trust the data and you have no information about risk and correlations, you invest less because you're a prudent investor. So to try and answer this question today, this is how we're going to do it. Luckily, the research and data availability have been improving in this area. So in this webinar, we're going to take the following approach. First, we're going to take a sort of 360-degree view of the data available and examine 3 different types of proxies of the asset class: listed infrastructure, appraisal-based indices, and mark-to-market indices. And you'll see quite quickly that we'll be left with only two options. Then we'll do a simple exercise, and we'll compare the behavior of appraisal-based proxies, like the Preqin Private Infrastructure Index, with the mark-to-market proxies like the Infrastructure 300 Index produced by Infra, in the case of a basic 60-40 portfolio, and see what kind of behavior we get for private infrastructure. In the end, we'll select the best private infrastructure proxy based on these tests. We'll also look at the role of granularity, and this is important because after all, each infrastructure portfolio is different. And so using the right granularity, the right level of granularity in the data for the benchmark can make a big difference. So we'll show you the difference between using different segments of the infrastructure universe as your benchmark. And finally, we'll look at a more normative question in a more realistic context with 10 asset classes, some liquidity constraints, etc. We will see how much infrastructure gets in the portfolio, including looking at infrastructure debt, and if there are different roles for infrastructure equity and infrastructure debt. First, let's look at the data. So the first proxy we can look at is any of the many listed infrastructure indices that exist. Now, I won't spend too much time here because we've seen this kind of results before in other research that we've published. Suffice to say that all the listed infrastructure indices have a very high correlation with listed equities, and in fact, a market beta, which is similar to other segments of the equity market. Here, for example, we're looking at the S&P Global Listed Infrastructure Index. We can see that it overlaps a lot with the S&P Global Broad Market Index. And in the table on the right, you can see that the correlation of listed infrastructure with various segments or themes of the listed infrastructure universe are equally high. In fact, looking at the market beta in the right-hand side column, listed infrastructure is highly exposed to the public equity market, and sometimes more than other segments, like, for example, the min-vol factor. So if the min-vol factor is not an asset class, why would listed infrastructure be an asset class here? Clearly, this is more like a subset of equities. And we already know that with a portfolio optimization exercise will conclude, right? If we use an optimizer here, it will replace 100% of equities with listed infrastructure, or it will elect to have 0% of listed infrastructure. It will be one or the other, depending on what else you put in there. But it won't be very interesting. So either way, we cannot use this data. Now, let's look at appraisal-based indices. So here we're looking at a frequent contender for the job of infrastructure benchmark, the Preqin Private Infrastructure Index. Unfortunately, we soon realized that this index exhibits a number of issues when it comes to an asset allocation exercise. It's very smooth. We can see that the returns are smoothed by looking at the serial correlation of the returns in the table at the bottom right. Normally, index returns are independent from one period to the next. So here we're looking at quarterly returns, which is what makes the volatility of the returns meaningful. Now, in this table, you see that the statistical test of the return autocorrelation is not significant for bonds or stocks. The p-value is very high. So it means that there is no autocorrelation in the bonds or stock returns that we're looking at here. But it is significant with a very high degree of statistical significance for the Preqin data. So this is, there's some serious serial correlation, autocorrelation in these returns. The immediate results of these smooth returns is that the reported volatility is very low. So this leads to very low return correlations with other asset classes. You can see this in the table at the bottom left. And what actually the return correlations are basically zero, which is hard to believe, and of course will lead to a very extreme portfolio optimization results. Another implication is the absence of proper risk measurement. So we have risk-adjusted returns that are very high, unbelievably high, you might say, with a Sharpe ratio of 1.15 for this period of 2008 to 2019. Depending on the period with this index, you can get a Sharpe ratio up to 4, which is clearly unbelievable. And of course, this data will create a structural dominance of the Preqin Sharpe ratio, which means that this proxy will dominate all other asset classes in a portfolio optimization exercise. So this second proxy is not very convincing either, but for the opposite reason that the listed infra, which was too correlated with equities. Here, we're not measuring risk at all. Next, let's consider our third and final proxy, the Infrastructure 300 index that produced by DEC, which is an index of 300 unlisted infrastructure equity investments in 22 countries worldwide. This index is built to capture the changes in the market price of risk and interest rates each quarter using secondary market prices to recalibrate a model of expected returns each quarter. So it's basically a mark-to-market approach. Now, if we look at the serial correlation test at the bottom right, we see that the Infrastructure 300 passes the test, meaning that its returns are not serially correlated. In other words, they're not smooth. And that is reflected in the volatility that is reported in the table at the top right, which is on par with equities, in fact, for that period from 2008 to 2019. And the Sharpe ratio is also much more reasonable. Now, as a result, the returns of the infrastructure asset class here are also correlated with equities and bonds. If you look at the correlations in the bottom left table, they're quite reasonable as well, but they're not zero. It's 30% correlation with bonds and 18% correlation with public equities. So unlike the other proxies, which were either too correlated or not enough, this one exhibits levels of risk and correlations that we should be able to work with for this exercise. Okay. So this was the data we could try and use. And let's go a bit further. Let's do a simple test to make sure that, obviously, we prefer the Infrastructure 300, no surprise here, but to make sure that we really want to use this one, we'll take a standard 60-40 portfolio of stocks and bonds, and we'll add either the Preqin index or the Infrastructure 300 and see what happens. We want to know how stocks and bonds will react to the addition of the infrastructure proxy in the portfolio. And we also want to see what indicative level of infrastructure investment we get in this optimized portfolio. These results, of course, are not very realistic, but they should tell us something about the quality of the data. So we take the in-sample target return of the 60-40 portfolio, which is 7.8% in this case. We don't have any constraint. And again, this isn't a really realistic exercise, but it lets the data speak for itself, right? We're not trying to steer the results one way or the other here. So what do we get? With the Preqin data, we get two interesting results. First, the infrastructure asset class allocation is very high. It's close to 70%. Of course, this is driven by these artificially low correlations and a high Sharpe ratio that we noticed earlier. And we also note that the asset substitution is not consistent. So the Preqin index is substituted with both the bonds and the stock buckets, as there's no economic logic for this substitution. That is because the true characteristics of the asset class, its volatility and its correlations, are in fact not available in the data. So it's a bit random, if you want. Conversely, if you look at the same results with the Infra 300 index, we get a consistent substitution between infrastructure and stocks, while the bond allocation remains pretty much untouched. Now that makes sense. Infrastructure equity is, after all, also equity. And also we get a much more reasonable allocation to infrastructure, about 30%. This is still very high, of course, but remember that this is a simple in-sample test with no constraints and only 3 asset classes. Right, so I want to insist on this. This exercise has its limits. It's just an in-sample exercise. We're using a specific period, which is the one for which we could compare the Preqin and the EDEC infra data. And it's quite a special period for infrastructure. Between 2008 and 2019, there are very strong performance. And it's also a short time series of quarterly returns. Okay, and again, there were no constraints. What these results clearly suggest is that in a more advanced exercise, using the Infra 300 should make more sense than using the appraisal-based index data. Now, there's one more thing I want to try. Some of you may be thinking, well, okay, we can always unsmooth these appraisal indices, right? Well, with unsmoothing, of course, the idea is to remove the serial correlations in the data, and it can be tempting to do this. In fact, I know quite a few quants quite like to do that. But this isn't straightforward, however. There are multiple methods to unsmooth the data, and none of them rely really on economic assumptions that might explain why this asset class has a certain volatility or certain correlations. Instead, unsmoothing relies purely on assumptions about the structure of the underlying returns and the number of lags, for example, to unsmooth. So things that are very external to what the asset class is about. It's just ex ante assumptions. So we did another test. We did the same 60-40 test, this time using the unsmoothed prequin data, and we used two different unsmoothing techniques. So in the first case, we used the standard Geltner method with one lag, and we get similar results with the smooth data than we had with the smooth data. That's interesting. We get also very high allocations. It's not as high as 40%, but it's quite high. And we get these inconsistent substitutions with bonds and equity. So then we changed the assumption about the unsmoothing process. We added just one lag in the unsmoothing of the calculations. And here we get completely different results. We get an allocation of 60%. So in the end, unsmoothing does not really help because it doesn't make the data more consistent or the results more consistent. And the allocation is essentially a function of the choice of unsmoothing technique. That's a little bit scary. So we see that appraisal-based data is not a very promising proxy of unlisted infrastructure in a strategic asset allocation context, even when you unsmooth it, right? So we'll be using the Info 300 index in the next multi-asset exercise that Abhishek will describe in a minute. But before diving in with the full strategic asset allocation exercise, it's useful to ask what infrastructure benchmark investors should be using. So here I want to talk about granularity for a minute, because this asset class is not investable as such, as a whole, right? Investors are mostly exposed to an ad hoc combination of segments in the private infrastructure universe. Each segment is different and implies different risk and return profiles. For example, in the table here, you can see that different segments in the infrastructure universe can have a range of returns and volatilities with a significant spread between the higher risk, higher return type of infrastructure and the other end of the spectrum. Now, to see that this matters, we're going to run the same, again, 60-40 exercise, but this time with different infrastructure sub-indices and see what different results we get. Okay, so this is a big table, but in this table, what you see is on the weight and the Sharpe ratio of a portfolio invested in the index that's referred to on each row. So the first row is the Info 300, and we have utilities, unlisted utilities. It's a subset of that universe, power, renewables, etc. Okay. And in the first set of columns in gray, you see the allocation that you get. So we're using the allocation that is implied by the Infra 300, but we're actually investing in the sub-index on the row, right? So we're using 29.5% to infrastructure, but we're actually investing in one of those sub-indices. And on the right-hand side, in blue, in the second set of columns, what you see is what happens if you actually build the allocation with the sub-index. Right? So you can see that there's a big difference. You get different allocations, and you get a different and positive difference in Sharpe ratio if you build the allocation with the correct granular sub-index rather than just building the allocation with the global index. The best example is the final row, in which you see how an investor with a hypothetical custom benchmark, which is 50% utilities and 50% airports, would invest suboptimally in infrastructure if they were using the Info 300 to define the weights. But with a custom benchmark, this hypothetical portfolio would lead to a different allocation and a much higher Sharpe ratio, right? So we see that by using the right data and including the right mix of infrastructure segments as the benchmark, we can completely change the results of the strategic asset allocation exercise. So the more precise the data, the better. The better defined your infrastructure investment strategy or existing portfolio, the more you can benchmark it better relative to other asset classes. So in conclusion for this part on the data, okay, we cannot use listed or appraisal-based proxies, even with unsmoothing. EDEC infra data gives us consistent results and gives us access to more granular benchmarks. So in practice, it makes a lot of difference. Now, let's see what kind of infrastructure allocation we get in a multi-asset context, given the source of data that we've selected. All right, so I'm going to pass the mic to Abhishek, who's going to present you the second part of this webinar.
Thank you, Frederick. I'll take over the screen now. All right, so far we have concluded that listed infra and appraisal-based indices should not be used for asset allocation exercise. And as Frederick mentioned, there are completely opposite reasons for this. With listed infra benchmark, we found a very high correlation with equities, and with appraisal-based infra benchmarks, we found a very low correlation with both equity and bonds. So clearly, these are not the suitable proxies to use. And now we take a step further than this proof of concept exercise, and we address a more normative question. What should be the role of unlisted infrastructure in a multi-asset class portfolio? And more importantly, we will consider serious data that will truly represent the risk and return of this asset class. In this study, we will implement three optimization approaches: return targeting, risk targeting, and equal risk contribution. And we will compare how the allocations differ between each of these approaches, and also the role that infra equity and infra debt play in these approaches. So the portfolio, in the portfolio, we have included a mix of 10 asset classes in total. There are 4 traditional asset classes: US equity, emerging market equity, corporate bonds, and government bonds. And in addition, we have 6 alternative investments: private equity, real estate, hedge funds, commodities, and of course, unlisted infrastructure. And here we have the privilege to split it further into infra equity and debt, since EDIC Infra produces separate indices for the two. And we note that private infrastructure debt, for example, has very different characteristics from its equity counterpart. And it should play an important role in the allocation where, for example, the focus is more towards liability management than return seeking. In this exercise, we will use forward-looking data. So in the first part of the presentation, we had used a rather simple optimization exercise, which was based on in-sample data. And then we implemented a return target optimization, which had put an even more emphasis on these return estimates. So overall, in that approach, the results can be very dependent on the sample chosen, and also the return estimates derived from that sample. So in this section, we wanted to build a more realistic approach for a multi-asset portfolio. And hence, we use forward-looking estimates of return, volatility, and correlation data. These views are developed like a Bayesian approach. They take into account the prior knowledge of data and other observations, and these views are updated as more data is observed from in the market. Let's first consider other asset classes besides infrastructure. And for these, we rely on the industry consensus. We have collected risk, return, and correlation estimates from leading asset managers and consultants, and we use their average view. And as you can see, they represent a very wide spectrum of reputed financial institutions such as BlackRock, JP Morgan, State Street, Kalan, and others. Typically, these forward-looking views are formed as a combination of long-term historical observations, and then there are specific views for each asset class as well, which may change as the short-term variations are seen in the risk and return of each asset class. For unlisted infrastructure, we use the expected return estimates produced by EDIC Infra. These estimates are updated every quarter using an explicit Bayesian model. And I want you to focus on this section at the bottom. Here we have a snippet of how equity expected returns are modeled. We follow a multi-factor approach, and we use secondary market transactions in this exercise. So whenever we observe a secondary market transaction, we compute the IRR for that deal. And from that IRR, we deduce the risk premia after taking out the effects of interest rates. Then we decompose that risk premia into different factors. So we have 5 main factors and some control variables in this model. And the objective being that with that new piece of data, we want to update these factor prices. So these are represented as lambda here. So every quarter, we will observe more and more data, and we will keep updating these factor prices. And with the combination of these prices and loadings, we can estimate the expected returns for all other companies in our universe. And that's a consistent approach that we can follow for our entire unlisted infra universe. So you can see that our approach is directly using a Bayesian technique by updating our prior belief that is based on 20 years of data collection. And it gets updated every quarter as we see more and more secondary market prices. This, in principle, is similar to the approach that is used by other industry practitioners. And the only difference being that probably this is more model driven rather than directly derived from the data. In this chart here, we have the expected returns going back up to 5 years for both infra equity and infra debt. For infra equity, we used the infra 300 index, and for infra debt, we have used the broad market private debt index. Until 2015, the expected returns for these indices were quite high as the infrastructure market was still developing. And this behavior is also sort of the result in how investors have priced these assets over the past few years. But in these recent periods, we have seen that the returns are more stable and they follow a very narrow range over this period. So we use the average of these 5 years as an estimate for forward-looking return. In this slide, we show the expected return and risk of all the asset classes considered, and also the Sharpe ratio computed, assuming a zero risk-free rate. We see that infrastructure has a very attractive Sharpe ratio as compared to the traditional asset classes. And the volatility estimate for infrastructure is also derived from that 5-year period that we saw earlier, and it represents the volatility of total returns in that period. And these estimates are quite reasonable. For infra equity, we get an estimate of 12.8%, which is nicely in between the equity and bond asset classes. The third variable we need for this exercise is the correlation between asset classes. And again, for asset classes besides infrastructure, we use the industry expectations here. We use their average view. And for the correlations with infrastructure, we use long-term historical data as an estimate of forward-looking correlations. We see that with bonds, the correlations are quite attractive. That's driven by their common interest rate exposure. And then there are also decent correlations with equity and other asset classes such as real estate. And before moving on to the optimization exercise, actually, we wanted to define these two investor profiles. We will use them to contrast the allocation results in the upcoming section. So first is the profile of a conservative investor. That's like a 20/80 portfolio. These are typically overfunded pension plans who are LDI focused, and they're looking to hedge their liabilities. Their asset allocation goal would be to protect the existing fund contributions and reduce the cost of hedging. We find that their annualized expected portfolio return is 2.8% and risk is 6.8%. And that's based on this 20/80 portfolio proxy. The second profile is of a 60/40 investor. And this is a more aggressive approach and resembles the underfunded pension plans. Their goal is to invest more in the growth section of the portfolio and generate higher returns. Their expected return is 4.3% and 10.6% based on this 60/40 portfolio proxy. So as I said, we will use these two profiles to contrast the allocation results later on. Now, with all this understanding of the data and the setup, we can start the optimization exercises. We'll explore 3 approaches in this study. And first one is probably the most rudimentary approach of return targeting optimization. Many investors should be able to relate to this approach, as a lot of them have return targets defined in order to grow the assets sufficiently to meet their liability obligations. In the box on the right, we explain this optimization setup. So the objective is to minimize the portfolio risk, and that is subject to some constraints. And as the name suggests, the first constraint is, of course, to meet the return target and exceed it if the optimality allows for the portfolio. There are two simple constraints also included. So no short positions should be allowed, and it's a full investment, so all weight should sum up to 1. In addition, we have added two explicit constraints in this exercise. One is on illiquidity, and we allow only 20% of portfolio to be allocated to illiquid assets. That's a combination of 5 asset classes. So infra equity and debt, real estate, private equity, and hedge funds. So we say that these 5 asset classes combined shouldn't exceed more than 20% of the portfolio. And then we have a diversification constraint also in this setup that effective number of final asset classes in the portfolio should be at least 6. And that's out of the 10, that's the extreme case that's possible. So with this optimization setup, we see these results here. First, in this plot on the left, you see there are return targets on the x-axis and weights on the y-axis, which represent the allocation to different asset classes. The two dotted lines, they represent the investor profiles that we had assumed earlier, and the details of these investor profiles are also available in this table on the right. First thing to note here is that all portfolios are sufficiently diverse, and that's on account of our explicit constraint. And all illiquid asset classes play an important role, including infrastructure and other illiquid asset classes as well. We focus on the two investor profiles in particular. They have a return target of 2.78% and 4.34%. So that's corresponding to their investing style. For the first type, we find that infra debt plays a larger role in the portfolio and gets almost 90% of the allocation that's given to infrastructure. For the second style, the more allocation is towards infra equity, and that takes up everything that's allocated to infrastructure. But there are also differences in other allocations. For example, in the conservative profile, there are more bonds and less equity. And in the aggressive profile, we see that there are lesser bonds and more equity in the portfolio. Final Sharpe ratio for both profiles is quite similar, but of course, that's with different expected return and target for the portfolio. And another thing to note here is that we run this exercise without infrastructure as well. So we take all the other asset classes, the same constraints, same optimization setup, and we try to find the expected Sharpe ratio for the portfolios. And we note that with infrastructure, we get approximately 6% better Sharpe ratio. And that's purely the effect of adding infrastructure in this optimization. So in terms of the infrastructure allocation, we have 3 main conclusions from this optimization exercise. The first is the global allocation to infrastructure is quite stable across all return targets and is typically in the range of about 10 to 12%. Second, in the more conservative portfolios, so that's the 2080 investing style, infra debt plays a more important role, and it substitutes the need to have more bonds in the portfolio. It has better risk-adjusted return than both corporate and government bonds, and hence it should also reduce the cost of hedging the liabilities. Third point, we note that aggressive investors who seek higher returns would still have an infra allocation of about 10%, but it would be exclusively allocated to infra equity. With that, we move on to the second approach, that's of risk targeting. So the setup is quite similar as the first one, but the objective and constraints have changed slightly. The objective here is to minimize the portfolio, maximize the portfolio return. And the most important constraint is the investors want to keep the risk of the portfolio lesser than a predefined target. So that's useful for the investors who already have a risk target in mind, and they want to find the optimal portfolio so that the risk is lesser than the target. We keep other constraints same, the same illiquidity target, illiquidity constraint as before, and the same diversification constraint of PNC. And these are the optimization results here. So in this plot, we have volatility target this time on the x-axis instead of the return target, and the y-axis still shows the allocation to different asset classes. The two vertical lines again show the expected volatilities of the two portfolios or two investor styles that we had considered. So here we note that with higher risk tolerance, the allocation shifts from fixed income assets to riskier assets, which can provide a higher return while assuming more risk. And in the case of two profiles of 20/80 and 60/40 investors, their volatility targets are quite different, 6.8 and 10.6%. But we find that the allocation to infrastructure is limited to infra equity only. Infra debt actually plays no role in the final optimal allocation. But there are differences in the allocation of other asset classes. So for the conservative profile, there's more allocation towards bonds. And for the aggressive profile, there is more allocation towards equity. And also, the conservative portfolio has a slightly better Sharpe ratio as compared to the aggressive profile. So from this exercise, we can again conclude that allocation to infrastructure is quite stable. I mean, there are differences between the roles infra equity and infra debt play, but the allocation overall remains quite stable and around 10% for both the conservative and more aggressive portfolios. One interesting thing we noted that infra debt is excluded from the portfolios after a risk target of about 6.5%. It is substituted by infra equity, and that's primarily driven because of these two reasons. One is the objective is to keep the risk low, lower than the target, but also to maximize the returns. So the optimizer focuses on the asset class, which can provide a higher return target, and the illiquidity constraint of 20%. So that also caps how much infra debt can be allowed in the portfolio. We have tried this exercise by relaxing this illiquidity target as well, and infra debt actually replaces quite a bit of bonds in the portfolio in that case. That brings us to the third optimization approach, and here we do something different. So far we had three estimated variables: return, risk, and correlations. But both these approaches, they depended quite heavily on these estimations of expected returns. And we know that the volatility and correlation, these are more convergent estimators and they are risk driven, whereas return estimators are not convergent. And it means that as we observe more data, the estimates of return can change quite significantly. That's not the case with the risk estimators. So some portfolio managers drop these techniques altogether. And the downside with that is they don't achieve an optimal portfolio, but they indeed obtain a more robust allocation because that's driven only from these convergent estimators of risk. We've mentioned some of these approaches here. So the minimum vol approach, or equal risk contribution, or the maximum decorrelation. These are the three approaches which don't take expected returns into account. So in this third exercise, we present the equal risk contribution approach, and it uses both volatilities and correlations of the asset classes and focuses on their contribution or total contribution to the portfolio risk. So this is the optimization setup. The goal is to reduce the risk contribution from all asset classes, and we keep the same constraints as before. We have an illiquidity constraint of 20%, and also we add a constraint on the target effective number of asset classes. And we will try different targets in this optimization exercise to contrast the allocation results. One point to note here is that if we didn't have any of these liquidity or ENC constraints, this approach would basically result in equal risk contribution from all asset classes. So we have partially restricted this optimization by adding these constraints. So same as before, we have an allocation plot, which has target number of effective asset classes on the x-axis, and then weights on the y-axis, which show the allocation to different asset classes. We also present three cases in more detail on the right, which represent the three different ENC targets. We note that with a lower ENC target, fixed income has a much larger allocation in the portfolio, since the focus is on reducing the risk contributions. And as ENC target is increased, optimizer forces other asset classes to participate as well. And the allocation is taken away from further away from equal risk contribution. We find that infrastructure allocation is quite reasonable with all the three cases here. We see an allocation of up to 10%, that's with ENC 6 criteria. And there are also differences in the allocations to other asset classes. For example, with a low ENC target, bonds play a bigger role. And then as it gets higher, other riskier asset classes start to participate in. The Sharpe ratios in all these exercises are quite similar to the previous approaches, around 0.6. So in terms of the allocation to infrastructure, there are two main conclusions in this exercise. For low ENC targets of 5 or less, we find that infrastructure allocation ranges between 3 to 5%. And then for high ENC targets of more than 5, the infrastructure allocation is around 10%. Overall, this infrastructure allocation is the lowest of the three optimization exercises that we have seen. Finally, we established that no matter what the target ENC is, infrastructure always plays a very important role in the portfolio. And for a higher ENC target of greater than 5, actually both infra equity and debt play a role in creating a diversified portfolio. So to conclude this section, we have seen three different optimization exercises, and we have also tried varying portfolio objectives by moving the targets of return, risk, or ENC. But we found one common conclusion, that infrastructure is always included in the portfolio, and the allocation has a reasonable range of about 10%, ultimately depending on the objective. With that, I'll hand it over back to Frederick, who will conduct a poll and then conclude the presentation. Thank you very much. Frederick?
Thank you, Abhishek. Let me take over the presentation again. Okay. So it's time for our customary poll, which we always do. So let me launch this poll. It's suitably an asset allocation poll. So we are going to ask you, in fact, there are two types of questions. For those of you who are asset owners, I hope you can see this now. Please answer the question, what is your asset allocation to unlisted infrastructure equity today? So you have a range of potential answers from 0 to over 10% on different buckets you can see on your screen. And at the same time, second question, what do you think it should be? So given what you've seen today, which is the second question. And then we'll have a question for everyone, which is the third question, which is to know whether, or to ask whether you think asset allocations to unlisted infrastructure will increase in the future. Okay, so I'm going to, as usual, give you a couple of minutes to answer. Okay, we have starting to have a good number of answers here, getting close to a large sample of answers, but please make an effort. We can do better than this. Actually, quite interesting picture is starting to appear. I think by the time you finished voting, I can show you the results. So hold on. I'm going to wait for another 15 seconds. So if you haven't voted, please do. Okay, so that's the end of the poll. I will turn it off, and I think I can share the results with you. So hopefully you can see this on your screen. Abhishek, can you confirm that this is visible?
Yes, it is.
Okay, good. And so that's interesting because we see pretty much the picture that we started with. If you remember, we were talking about the OECD survey at the start and how most investors are investing on average 2% to infrastructure, and then some more, but obviously in general, these allocations were quite low. And here we see precisely this picture. of most answers being in the 0 to 2%, and perhaps also towards the between 2 and 5% bucket. And to the extent that you've been convinced by what you saw today, I think we can see that the desired allocations are much higher, going towards the 10% that Abhishek was mentioning as being given the constraints of the exercise that he presented, being quite a likely result. Okay, and almost everyone thinks that infrastructure allocations are going to increase, which is perfectly logical if you think about the first two questions, how they were answers. They pretty much have to increase if everybody would like to allocate some more, which of course will require, as you now understand, a proper benchmark and one that is tailored to your infrastructure investment strategy. Okay, thank you for that. I'm going to now conclude. So let me give you our takeaways first. I'm going to repeat a few things here, but it's always good, right, to summarize. First, we prefer using a mark-to-market proxy because it exhibits the convincing characteristics in terms of the data. So you now know that using appraisal-based indices, whatever they are, causes lots of problems, and importantly, that unsmoothing them doesn't really help you. So that's important. Luckily, the data that we showed you, the Info 300 or the various sub-indices that we produce, address all of these flaws in the data and give us much more interesting and much more reasonable, convincing results. Second key takeaway, in a 60-40 return target test kind of framework, as expected, we find that the appraisal-based data gives us very strange results. That's a direct conclusion from the first point. But that with EDEC Infra, we get the kind of reasonable and consistent behavior of the data that we expected. The substitution behavior is consistent. It's equity, unlisted infrastructure equity versus stocks. And the allocation, while high, of course, because this is a completely unconstrained and a very basic and also in-sample exercise, it's not completely crazy. Whereas with the appraisal-based data, you get completely unusable kind of results. So that's important. Second set of takeaway, so in a more forward-looking multi-asset class framework, using this data, using EDEC Infra data for unlisted infrastructure equity and also private infrastructure debt, as well as the industry consensus for other asset classes. So here, there were several questions during the webinar about why we had this and that allocation to other asset classes. And it's mostly the result of these industry consensus information that we've added to this exercise. So it's I would say, not really the result of anything that we've done. It's just these are a bunch of consensus observations and hypotheses. But using these for a range of asset classes, which is familiar in the portfolio, we find consistent allocations to infrastructure, typically in the 10% range across different optimization techniques. So it was very interesting to see the consistency in particular between the minimizing risk contribution approach and the return targeting approach. And showing that infrastructure always has a role to play in a portfolio, which is, I think, also a key finding here. Other key finding, return-seeking investors or portfolios can allocate more, if not actually exclusively, to unlisted infrastructure equity. But third point, and I think this is really important because infrastructure debt is a rising asset class, the role of private infrastructure debt can be really significant, either in addition or in substitution to unlisted infrastructure equity. In a return-seeking framework, of course, infrastructure debt can be substituted to infrastructure equity for the more conservative investors, who would then benefit from better liability hedging. But also, more generally, infrastructure debt is likely to have a role to play. So this is kind of what we want to work on next. So this is the sort of final final part of this presentation where I show you something that is a bit kind of still in the works, but it's something that we wanted to show you briefly to show you what we're going to do next, what the next paper on this and the next webinar probably will be about, because there's clearly a lot of work to do on the role of infrastructure in a liability-driven context here, given these results. So here, for instance, you see an exercise that is one of targeting the volatility, sorry, the correlation with bonds. So in the context of a liability or an asset liability management exercise, targeting the asset allocation, sorry, targeting the correlation with bonds, sorry, while maximizing returns. And you see that as the correlation with bonds, which would be the discount rate of the liabilities, of course, increases, so you get towards what you see on the horizontal axis, towards 75% of correlation with this long-term bond return target, we see that infrastructure debt starts to play an important role in the portfolio. So that also suggests that in different contexts, in different setups, there'll be interesting findings for infrastructure debt in an LDI context. So this is the last point. We will develop this approach further because it's important for investors who organize their asset allocation in terms of ALM. And the upcoming research that we will aim to produce next will be to characterize and to quantify the benefits of infrastructure investments in an LDI context, in particular to improve how it can improve the cost of hedging in nominal or real terms through infrastructure investment, and how it can have an impact in terms of the volatility of the funding ratio as well.